So let's now discuss the preparation of the consolidated financial statement subsequent to acquisition date. So this discussion is focused on 1 year after acquisition date because the preparation of the Conso FS 2 years or more after the acquisition date is a bit different from the procedures that we are going to prepare for this particular period. So also this is a continuation of the consolidated FS that we have prepared at acquisition date, same for Tick and Talk company. So if you have not watched that video, please watch that video first. I'll just put the link on the description box. Then after you watch that, proceed to this discussion. So first, let us review the composition of the financial statements as of the acquisition date. So again, the consolidated financial statements includes the separate financial statements of the parent and the subsidiary, but with some adjustments. So since the parent and the subsidiary are both existing, they have both their own separate financial statements. And those will become part of the consolidated financial statements. So how will it be presented in the Conso financial statements as of the acquisition date? For the assets of the parent that were recorded at book value will become part of the consolidated financial statements. So that is at book value. Then for the subsidiary, although the subsidiary's separate financial statements, the assets are recorded at book value, which is at historical cost. When these assets will be presented in the consolidated financial statements, they must be presented at fair value as of the acquisition date. Because as of the acquisition date, it is considered that the parent company purchased the subsidiary company. And again, if an asset is newly purchased, the asset should be capitalized at fair value. That is why the assets of the subsidiary must be recognized in the consolidated financial statement at purchase date or acquisition date at fair value. Then, the consolidated assets must also include the goodwill that resulted from the business combination, if there is a goodwill. So the total consolidated assets shall be the book value of the parent, the fair value of the subsidiary's assets, and the goodwill resulted from the business combination. Of course, it should not include the investment in subsidiary account of the parent, because the investment in subsidiary account pertains to the investment of the parent over the subsidiary. So there may be investments that will appear in the consolidated financial statements, but those investments must only include those that does not pertain to control. So for example, investment in associate. So the investment in associate may be part of the consolidated financial statements because there is no control. Also, for example, financial asset at fair value through other comprehensive income. That may also be part of the consolidated financial statement because there is no control. So as long as there is control with regards to the investment, in this case, the investment in subsidiary, it should not appear in the consolidated financial statements. Next, for the liabilities of the parent that will form part of the consolidated liability shall be at book value. However, for the subsidiary, the liabilities of the subsidiary that will appear in the consolidated financial statements, again, must be measured at fair value. Although the separate financial statement of the subsidiary is recorded at book value or at historical cost, there will be adjustments so that we may present the liabilities of the subsidiary in the consolidated financial statements at fair value. Then let's proceed to the shareholders' equity. So for the shareholders' equity, this should pertain to the shareholders' equity of the single economic entity or the controlling interest. So the controlling interest is the parent entity. So in the consolidated financial statements, the single economic entity is viewed as the parent. That is why The shareholders' equity in the consolidated financial statement must be the shareholders' equity of the controlling interest, which is the parent. So, in the consolidated shareholders' equity, the share capital, the retained earnings, and the other comprehensive income or the other shareholders' equity accounts of the parent shall be included in the consolidated shareholders' equity. The shareholders' equity of the subsidiary shall not be included in the consolidated shareholders' equity because the subsidiary is not viewed as the single economic entity and the subsidiary has no control. Between the parent and the subsidiary, the parent has control over the subsidiary. That is why the shareholders' equity of the controlling interest who has the control should appear in the consolidated shareholders' equity. Another item in the consolidated shareholders' equity is the non-controlling interest. So the non-controlling interest pertains to the percentage of ownership that is not purchased by the parent company. So, which means at acquisition date, the shareholders' equity will include all the shareholders' equity accounts of the parent as of acquisition date and non-controlling interest at acquisition date. So this is the common appearance of the consolidated financial statement at acquisition date, specifically for statement of financial position. If you are asking how about income statement at acquisition date, the consolidated income statement, if ever, at acquisition date, shall only include the income statement of the parent, not the income statement of the subsidiary. Because again, the controlling interest is the parent. The parent has control over the subsidiary. So the single economic entity is viewed as the parent. That is why the income statement of the parent shall be the income statement as of the acquisition date for consolidation purposes. Now, let's proceed to subsequent to acquisition dates. So let's discuss this by answering our illustrative problem. So the following are the trial balances of Tick and Talk Company as of December 31, 2020. So this is 1 year after the acquisition date. Our acquisition date is January 1, 2020. So this is after the first year of business combination. So we have an investment in subsidiary account in Tick. So Tick is the parent. The investment in subsidiary has an acquisition cost of 5,760. So we have an additional information, letter A. During the year, Goodwill is impaired by 10 pesos. Then Talk Company purchased land from Snapchat Corporation during the year for 1,500. Talk Company purchased land for 3,000 and classified it as an investment property. Then letter C, the property has no available fair value. Hence, the cost model is used. So first, in the preparation of the consolidated financial statements 1 year after acquisition date, the first thing that we will do is to prepare again the eliminating entry that we made at acquisition date. And why do we need to prepare the eliminating entries again? Because this is the difficult part of the consolidated financial statements subsequent to acquisition date. We will prepare repeatedly the eliminating entries that we have made in prior years since acquisition date. So that is why you must keep an organized record with regards to the eliminating entries that you have made when it comes to the preparation of the consolidated financial statements for previous years. Because you need those eliminating entries in the preparation of subsequent years' eliminating entries. For example, if you are preparing a consolidated financial statement for a 50-year-old group of companies, the eliminating entries will include the net effect of all the eliminating entries for the past 49 years of that group of companies. So that is why you should practice more on the preparation of the eliminating entries. Since this is only 1 year after the acquisition date, we have few eliminating entries that we will repeat on December 31, 2020. And why do we need to repeat these eliminating entries? Since eliminating entries are only working paper eliminating entries, these eliminating entries is not reflected in either books of the parent or the subsidiary, which means these are not recorded in both separate financial statements of tick company and talk company. So if in the eliminating entries we are adjusting the assets and liabilities of the subsidiary, so it will be recorded at fair value as of acquisition date, those adjustments are not reflected in the trial balance of the subsidiary company because the assets and liabilities of the subsidiary company in its separate records are kept at book value or at historical cost. So in order for us to present these assets and liabilities at fair value as of acquisition date, that is why we need to prepare the eliminating entries. And we need to repeat this every year so that every eliminating entries that did not reflect in any of the books will still reflect on the consolidated financial statements. So first, let's prepare again the eliminating entry as of acquisition date. So if you remember, the eliminating entries as of the acquisition date includes three, and that is the elimination of the shareholders' equity of the subsidiary, the adjustments of the subsidiary's assets and liabilities so that we may present these assets and liability items at fair value, and the goodwill, which is the result of the business combination or the bargain purchase gain, whichever is applicable between goodwill or bargain purchase gain. And when we include these three in the eliminating entries, we will eliminate the investment in subsidiary account and we will recognize the non-controlling interest. So eliminating entries as of the acquisition date. So first is the elimination of the shareholders' equity accounts of the subsidiary. So we need to debit share capital 1,600, then debit share premium 400, and debit retained earnings at 4,600. So if we will compare these amounts to the trial balance available as of December 31, 2020, which is already 1 year after acquisition date, the share capital is 1,600 and the share premium is also 400 because there are no changes for these two shareholders' equity accounts. Then the retained earnings here is 4,600. So the 4,600 retained earnings of the subsidiary as of December 31, 2020 pertains to the beginning balance of retained earnings dated January 1, 2020, which is our acquisition date. So that is why the amount debited for retained earnings is 4,600. So now we're done eliminating the shareholders' equity of the subsidiary. Next is the fair value changes. So these fair value changes pertains to the undervaluation and overvaluation of the subsidiary's assets and liabilities. So first is for equipment. We debited accumulated depreciation for 40 pesos. Again, always remember if the asset has a contra account, so for example, property, plant, and equipment, the contra asset is accumulated depreciation. As of the acquisition date, in the eliminating entries, all accumulated depreciation accounts should be close to zero in the consolidated financial statements. That only applies for the subsidiary. The accumulated depreciation for the parent will still be part of the consolidated financial statements. So for the subsidiary, we debited accumulated depreciation equipment for 40 pesos and accumulated depreciation building for 240 pesos. So that is why you need to watch the previous video because these amounts were discussed during the acquisition date consolidated financial statements. Next is the patent. We debited 15 pesos and land for 100 pesos. Then we credited equipment for 58 pesos, building for 786 pesos, and inventory for 4 pesos. Then for the liability, we credited premiums on bonds payable for 50 pesos. So these are all the fair value changes for the assets and liabilities of the subsidiary. Now, let's proceed to the goodwill. So after we eliminated the shareholders' equity accounts of the subsidiary and recognized the over and undervaluation of the subsidiary's assets and liabilities, let's now recognize the goodwill, which is the result of the business combination. So our goodwill amounted to 1,103 pesos. So we debited goodwill for 1,103. Now, after we eliminated the shareholders' equity of the subsidiary, recognize the fair value changes as well as the goodwill from the business combination, now we eliminate the investment in subsidiary account and the recognition of the non-controlling interest. So investment in subsidiary account is credited for 5,760. So that is the amount of investment that we recorded in the parent's books and credited the non-controlling interest at 1,440 pesos. So this is the fair value of the non-controlling interest as of the acquisition date. So let's check whether the debits and credits are balanced. So these are balanced. So these are the eliminating entries that we made at acquisition date. Again, we are preparing the consolidated financial statements 1 year after December 31, 2020. So these eliminating entries are prepared December 31, 2020. So again, as I have said earlier, any eliminating entries that we prepared in the previous period should be recorded again during the current year eliminating entries. So the acquisition date eliminating entries are again prepared for the eliminating entries December 31, 2020. Now we're done with the eliminating entries at acquisition date, which we prepared again as of December 31, 2020, which is 1 year after the acquisition date. Now let's proceed to the additional eliminating entries. So again, the acquisition date eliminating entries that we have prepared includes the elimination of the subsidiary's shareholders' equity, the adjustments of the subsidiary's net assets to its acquisition date fair value, the recognition of goodwill or bargain purchase gain. Then the additional entries subsequent to acquisition date includes the establishment of beginning balance of the consolidated balances of the following accounts: the retained earnings, the other comprehensive income, and the non-controlling interest. So these are shareholders' equity accounts. So among all the shareholders' equity accounts, these three, the retained earnings, other comprehensive income, as well as the non-controlling interest, these accounts are affected by a lot of transactions every single year. That is why we need to determine the updated beginning balance for consolidation purposes. For other shareholders' equity accounts, for example, the share capital in the consolidated financial statement, again, shall be the share capital of the parent company because the parent company is the controlling interest and is considered as a single economic entity. And since the changes in the share capital account is only affected by few transactions, it is easier for us to determine the beginning balance of the share capital account. However, for these three particular shareholders' equity accounts, since there are voluminous transactions that affect these accounts, it is harder to monitor the balances of each of these accounts. Then next is the elimination of intercompany transactions. When we say intercompany transactions, these are the transactions that occurred within the group of companies. This may be a transaction between the parent and the subsidiary or between subsidiaries within the group of companies. So why do we eliminate intercompany transactions? Since the consolidation of financial statements is based on a single economic entity, all transactions that occurred within the group of companies must be eliminated, because only transactions of the group with outside parties should be reflected in the consolidated financial statements. So any internal transactions should be eliminated. So again, we eliminate intercompany transactions because the consolidated financial statements should only present transactions of the group to outside parties. And when we say outside parties, it does not include the transactions of the parent with its subsidiary or the transaction of a subsidiary with a fellow subsidiary. Next is the amortization of excess over book value. If you can remember, the excess over book value was computed during acquisition date when we prepared the acquisition analysis. So, in the amortization of excess over book value, it includes two steps, which is the update of the acquisition date fair value as of year end of the current reporting period and impairment of goodwill, if any. So based on our eliminating entry that we made at acquisition date, we adjusted the subsidiary's net assets to its acquisition date fair value. This is a working paper eliminating entry. It is not recorded in the books of the subsidiary. So which means in the subsidiary's books, its assets and liabilities are still recorded at historical cost, which is in the perspective of the subsidiary. But since for consolidation purposes, it must be presented at fair value at acquisition date, that is why we need to prepare this eliminating entry at acquisition date and repeated it every year subsequent to acquisition date. Why is there an update needed for the acquisition date fair value? The most common type of example would be for the property, plant, and equipment. So, for example, the equipment of the subsidiary is recorded at book value in its separate financial statements. However, for the consolidation purposes, it should be at fair value. So that is what we did at acquisition date. If 1 year have passed, the separate financial statements of the subsidiary depreciated its equipment based on its historical cost, because that is the separate records of the subsidiary. However, for consolidation purposes, when we depreciate the equipment of the subsidiary, it should not be based on the historical cost of the equipment in the perspective of the subsidiary. For consolidation purposes, it should be depreciated based on the fair value of such equipment at acquisition date. So this means that the equipment is carried differently in the consolidated financial statements compared to the records of the subsidiary, as well as the depreciation expense. The depreciation expense in the books of the subsidiary may be different from the depreciation expense that we must record in the consolidated financial statements. Because again, the depreciation expense for the subsidiary in its separate books is based on its historical cost. However, for consolidation purposes, the depreciation expense should be based on the acquisition date fair value of such equipment. So, in order for us to adjust the depreciation expense recorded in the books of the subsidiary, we need to amortize the excess over book value so that the depreciation expense that will appear in the consolidated financial statement shall be based on the acquisition date fair value of such equipment. And the last eliminating entry, which is subsequent to acquisition date, is the recognition of the non-controlling interest share in the subsidiary net income adjusted for consolidation purposes. So, this is the last eliminating entry because we need to determine the net income of the subsidiary for consolidation purposes. When we say net income of the subsidiary for consolidation purposes, it does not necessarily mean this is the income also of the subsidiary in its separate financial statements. The net income of the subsidiary should be adjusted. for consolidation purposes. And what are these adjustments? These are the elimination of intercompany transactions and the amortization of excess over book value. So that is why these two eliminating entries must be made first before we prepare the eliminating entry related to the recognition of the non-controlling interest share in the subsidiary's net income. Now, let's proceed to the eliminating entries subsequent to acquisition date. So first entry would be the elimination of intercompany transactions. So the first eliminating entry here, which refers to the establishment of beginning balances of the consolidated balances of the following accounts, is not applicable if the reporting period is only 1 year after the acquisition date. Because as of December 31, 2020, which is only 1 year after the acquisition date, the beginning balances of these accounts for 2020, which is also the acquisition date balances, which we already established when we prepared the acquisition date eliminating entries. So this particular eliminating entry is only applicable if the operations of the combined entity is already 2 years or more. So since this is not yet applicable, let's proceed to the elimination of intercompany transactions. So based on the problem, let's find any intercompany transaction, which means we need to look for transactions between TIC and TOC. So based on the additional information, TOC company purchased land from Snapchat Corporation during the year for 1,500. TOC company also purchased land for 3,000 and classified it as an investment property. The property has no available fair value, hence the cost model is used. So Snapchat Corporation is not a subsidiary or is not related to TIC and TOC company. So which means this transaction is a transaction to unrelated parties. So this is not a intercompany transaction, and this will not be eliminated in the consolidated financial statement. So looking at the trial balance, the possible intercompany transaction is the dividend income of TIC company. So why is the dividend income of TIC company pertains to an intercompany transaction? Looking at the asset accounts of TIC company, the investment account of TIC is only the investment in subsidiary, which is an equity instrument. So there is no other way that TIC company may earn dividend income other than its investment in subsidiary. So which means that the dividend income of TIC for 320 pesos comes from the dividend declared by TOC company, and the amount declared by TOC company is 400 pesos. So the percentage of ownership of the acquirer is 80%. That is why 80% of 400 is 320 pesos, which is the dividend income of the acquirer. So this is the intercompany transaction that we need to eliminate for this period. So subsequent to acquisition date, let's eliminate the intercompany transactions. So in eliminating the dividend income, since the dividend income has a credit balance, to eliminate this account, we need to debit dividend income for 320 pesos. And we need to credit dividends paid. This dividends paid is the 400 pesos declared by TOC company. Then there is a difference of 80 pesos, and this will be debited to non-controlling interest. So why do we need to prepare this eliminating entry? So first, the dividend income should not appear in the consolidated financial statements because the income that should appear in the Conso FS must all income that is earned from outside party. So if there are income earned within the entity or within the group of companies, those must be eliminated. And part of that is the dividend income. As well as the dividends paid, we need to eliminate the dividends paid of all subsidiaries. So take note that we need to eliminate all dividends paid made by all subsidiaries. So this means if there are two or more subsidiaries and those subsidiaries declared their respective dividends, those must be eliminated because the dividends paid that must appear in the consolidated financial statement is the dividends paid by the controlling interest, which is the parent. So after this eliminating entry, the dividends paid that will appear in the consolidated financial statement is the 500 pesos dividends paid by the acquirer. And the 400 dividends paid by the acquiree shall not appear. That is why we credited dividends paid. And dividends paid has a debit balance because if you remember that in declaring dividends, we debit retained earnings. So in reality, dividends paid is not actually debited directly to retained earnings. There is a temporary account used in order for us to easily monitor the amount of dividends. So instead of debiting retained earnings, some companies debit dividends paid or dividends. So this is the account title debited upon declaration and payment. That is why it has a debit balance. So to eliminate this, it will be credited. So the 80 pesos, which is 20% of 400, is a debit to the non-controlling interest. So why do we debit non-controlling interest for any dividends paid by the subsidiary? So what is a non-controlling interest? So as we have discussed, this is the share of ownership in a subsidiary's equity that is not owned or controlled by the parent corporation. So since the parent has a percentage of ownership of more than 50% to less than 100%, the parent is the controlling interest, and the equity that is not purchased by the parent company is called the non-controlling interest. So what is the purpose of the non-controlling interest? So the non-controlling interest is the portion of the subsidiary's shareholders' equity that pertains to the minority or non-controlling interest. So basically, this is really based on the shareholders' equity of the subsidiary. So this represents the remaining portion of the shareholders' equity of the subsidiary that pertains to the non-controlling interest that is not owned by the parent. So what are the movements in the non-controlling interest account? So since this is actually based on the shareholders' equity of the subsidiary, all movements in the subsidiary's shareholders' equity accounts must have a corresponding movement in the non-controlling interest up to the extent of their ownership. So basically, the non-controlling interest is the shareholders' equity of the subsidiary multiplied by the percentage of ownership of the NCI. So which means if this is the shareholders' equity of the subsidiary multiplied by the percentage of ownership of the NCI, it means that any movements in the shareholders' equity accounts of the subsidiary is also the movement on the non-controlling interest. If the shareholders' equity of the subsidiary increases because of net income, the non-controlling interest should also increase because of the net income, but multiplied by the percentage of ownership. And if the shareholders' equity of the subsidiary decreased by the dividend declaration, the non-controlling interest account should also decrease for the dividend declaration, but multiplied by the percentage of ownership. So always remember that the non-controlling interest account is the shareholders' equity account multiplied by the percentage of ownership. However, the non-controlling interest is not based on the historical cost or the book value of the shareholders' equity of the subsidiary. The non-controlling interest is based on the fair value of the firm or the acquiree as of the acquisition date. So that is the only difference. So for this eliminating entry, since the subsidiary declared a dividends of 400, it will decrease the shareholders' equity of the subsidiary in its separate books. So if it decreases the subsidiary's shareholders' equity, the NCI account should also decrease, however, multiplied by the percentage of ownership. So decreasing non-controlling interest is a debit because non-controlling interest is an equity account with a credit balance. So we debit 80 pesos for non-controlling interest in order for us to decrease the non-controlling interest. So since there are no other intercompany transactions, let's now proceed to the amortization of excess over book value. So the amortization of excess over book value is to update the acquisition date fair value as of year end of the current reporting period. So how do we amortize the excess over book value? So since the excess over book value pertains to the fair value differential or fair value changes and the goodwill, so we need to amortize both the fair value changes and the goodwill. Let's start with the goodwill. The goodwill will be amortized upon impairment. It is not amortized on an annual basis. However, it is subject to impairment testing, and the excess over book value that pertains to goodwill shall be amortized during the year of impairment. Next is the fair value changes. So the fair value changes pertains to the overvaluation and undervaluation of the subsidiaries' net assets, which means assets and liabilities. So let's discuss first the fair value changes related to assets. So at the minimum, we have two types of assets, the non-depreciable asset and depreciable assets. So first, non-depreciable assets. So the excess over book value related to a non-depreciable asset shall be amortized only at the time of sale. So for example, inventory. Inventory is a non-depreciable asset. So the excess over book value that is related to the inventory will be amortized at the time of sale. Now, for depreciable assets, we have two ways to amortize the fair value changes. First is through depreciation. So here, we will adjust the depreciation recorded by the subsidiary in its separate records so that the depreciation expense that will reflect in the consolidated financial statement shall be based on the acquisition date fair value of the depreciable asset or at the date of sale. So for example, several years have passed, then the equipment of the subsidiary was sold. So any remaining fair value changes that is still unamortized as of the date of sale shall be amortized in full at the time of sale. So for the liabilities, the fair value changes related to the liabilities shall be amortized upon amortization of the discount or premium on the liability or at the date of retirement. Now let's discuss the reason why we amortize the excess over book value. So the very reason why we amortize is to update the assets and liabilities of the subsidiary and the related nominal accounts. So to better explain, let's start with the inventory. So inventory is a non-depreciable asset, which means that the difference between the fair value and book value shall be amortized at the date of sale or the year of sale. So since there is no data or information with regards to the date of sale specific to this inventory, we will apply the FIFO method. So which means if this is the beginning inventory for 2020, because this is the inventory as of January 1, 2020, which is the acquisition date, so this will be the beginning inventory for 2020. So we assume under FIFO method that all these inventory were sold during the year. That is why the full difference of 4 pesos between the fair value and book value shall be amortized during the year in full. So what is the effect of the amortization of the 4 peso difference between the two? First is, we will reverse the inventory that we recorded in our eliminating entry as of the acquisition date, because the eliminating entry that we prepared as of the acquisition date only applies to assets and liabilities as of January 1, 2020. Since the consolidated financial statements that we are about to prepare is for December 31, 2020, this particular inventory no longer applies for the statement of financial position, because the inventory that must appear in the statement of financial position as of December 31, 2020 should be the ending balance. However, this particular inventory is the beginning balance. So this is the particular entry related to the inventory that will be reversed during the entries in the amortization of excess over book value. And the related nominal account for the inventory is the cost of sale. So the cost of sales recorded in the acquiree's book is at 960 pesos. So take note, the 960 pesos is the cost of sales in the separate financial statements of the acquiree. And the 960 cost of sale is computed with a beginning balance of 240 because the 240 inventory beginning is the beginning inventory in the separate financial statement of the acquiree. However, for consolidation purposes, the beginning inventory of the subsidiary is not valued at 240. Instead, it is valued at the acquisition date fair value of 236 pesos. Which means that when we compute for the cost of sale for consolidation purposes, the beginning balance of inventory that we must use is 236 pesos. Therefore, the cost of sales for consolidation purposes is lower compared to the 960 cost of sale recorded in the acquiree's separate financial statements. So the 960 cost of sale in the books of the subsidiary is overstated compared to the subsidiary's cost of sale for consolidation purposes. So which means we need to reduce the 960. And how do we reduce the 960? That is by crediting cost of sale. So our eliminating entry for the amortization of excess over book value first for inventory is debit inventory for 4 pesos and credit cost of sales for 4 pesos. So again, why do we debit inventory by 4 pesos? Because we need to reverse the credit to inventory for 4 pesos in the acquisition date eliminating entry. And we credit cost of sales for 4 pesos because we need to reduce the 960 cost of sale recorded in the acquiree's books because the 960 is overstated compared to the subsidiary's cost of sale for consolidation purposes. So, looking at this entry, the cost of sale of the subsidiary that will appear in the consolidated financial statements will be 960 less 4 pesos or 956 pesos. So that will be the cost of sale of the subsidiary that will appear in the consolidated financial statements. Now, let's proceed to land. So the land is also a non-depreciable asset. So the amortization of the difference between the fair value and book value of the land as of the acquisition date of 100 pesos will be amortized only upon sale. And since there is no information with regards to the sale of the land of the subsidiary, the 100 peso difference between the fair value and book value shall not be amortized. Now, let's proceed to equipment. So the equipment is recorded at 360 in the books of the subsidiary as of January 1, and 342 is the fair value as of the acquisition date. So, in the statement of financial position of the acquiree, the book value of the equipment of the acquiree is based on the 360 carrying amount as of January 1. So when the acquiree computed for the depreciation expense computed by the acquiree in its separate financial statements is 40 pesos, which is 360 divided by 9. And the 9 is the 9 years remaining useful life of the equipment. So again, the depreciation recorded by the acquiree in its separate financial statements is 40 pesos or 360 divided by 9. However, for consolidation purposes, the depreciation expense for the equipment of the subsidiary will not be based on 360 pesos. Instead, it will be based on 342 pesos, still divided by 9 pesos, which means that the depreciation expense that must appear in the consolidated financial statements that is related to the equipment of the subsidiary is 38 pesos or 342 divided by 9. So if we will compare the 38 pesos depreciation expense for consolidation purposes and the 40 peso that is recorded by the acquiree, there is a difference of 2 pesos. And the difference of 2 pesos is the amortization of the excess. Again, the difference between the fair value and book value of the equipment is 18 pesos. And to amortize this will be amortized through depreciation. So which means the 18 pesos will be fully amortized only at the end of 9 years. So for this year, 2020, the first amortization will be 2 pesos, which is 18 pesos divided by 9 years. So that is how we computed for the 2 pesos. The effect of the 2 pesos amortization is to decrease the 40 peso depreciation expense recorded by the acquiree to depreciation expense of 38 pesos that must appear in the consolidated financial statements. So this procedure of 18 pesos divided by 9 years only applies when the depreciation method is straight line method. Because if the depreciation method is other than straight line, we cannot just divide the 18 pesos by 9 years. So what is our entry? So our entry is to reduce the depreciation expense for 2 pesos. So to reduce the depreciation expense is to credit the depreciation expense. So we credit operating expense because in our trial balance, we only have 2 types of expenses, operating and non-operating. So depreciation is an operating expense, so credit operating expense so that we can reduce the depreciation expense by 2 pesos and debit accumulated depreciation. Next is the building. So since the equipment and the building are both overvalued, which means that the book value is higher than the fair value, so same explanation applies to the building. So again, the amortization of the 546 pesos is through depreciation, and the amortization will end after 13 years, which is the remaining useful life of the building. Again, the purpose of the amortization of the 546 difference between fair value and book value is to adjust the depreciation expense recorded by the subsidiary. So how much is the depreciation expense recorded by the subsidiary in its separate financial statements? That is 1,560 divided by 13 years is equal to 120 pesos. So the depreciation recorded is 120 pesos. However, that is not the depreciation expense for the building that will appear in the consolidated balances. Instead, it is computed as 1,014 divided by 13 years is equal to 78 pesos. So from 120, it must be recorded to 78 pesos. There is a difference of 42 pesos. So from 120, the amount recorded, we need to reduce the depreciation expense to 78 pesos. So the difference is the current year amortization, 42 pesos. And the other way to compute for the 42 pesos, since we are using the straight line method of depreciation, is 546 divided by 13 or 42 pesos. Since for the building, we need also to decrease the depreciation expense, so same entry as the equipment. So the entry will be debit accumulated depreciation for 42 pesos and credit operating expense for 42 pesos related to the depreciation expense. Now let's proceed to the patent. So unlike equipment in building, patent is undervalued, which means that the book value is lower than the fair value as of the acquisition date. So here, the difference is 15 pesos. So the amortization for the year is 15 pesos divided by 5 years, which is 3 pesos. So what is the effect of the amortization of the 15 pesos? So that is to adjust the amortization expense that is recorded by the subsidiary in its separate financial statements. So what is the amortization expense recorded by the acquiree? So it is computed as 320 divided by 5 years is equal to 64 pesos. So the amortization expense of the patent recorded in the separate books of the acquiree is 64. However, the amortization expense of the patent that must be presented in the consolidated financial statement must be computed as 335 pesos divided by 5 years equals to 67 pesos. So, which means from 64 pesos, the amount recorded, we need to increase the amortization expense to 67 pesos. So, the eliminating entry related to the patent is to increase the amortization expense of the patent. So, that is by increasing the operating expense. So, debit operating expense for 3 pesos and credit patent for 3 pesos. Then for the bonds payable, the bonds payable has a difference of 50 pesos between fair value and book value. So we recorded the 50 pesos in our acquisition date eliminating entry as premium on bonds payable. Using straight line method of amortization for the premium on bonds payable, our amortization of the premium for this year is 10 pesos, which is computed as 50 divided by 5 years. Of course, we cannot divide the 50 by 5 years remaining maturity if the amortization method is other than straight line. For example, effective interest method. We cannot just simply divide 50 by 5. But for simplicity, for the sake of this discussion, we will use the straight line method. So just divide 50 pesos over 5 years. So what is the entry to amortize the premium on bonds payable that we recorded in our acquisition date eliminating entry? If you still remember the discussion on Intermediate Accounting 2, premium on bonds payable upon amortization is debited. So we debit premium on bonds payable for 10 pesos, which is the current year amortization. Then credit interest expense, which means that every amortization of premium on bonds payable will decrease the interest expense. So since we have no interest expense in our trial balance, instead we will use the non-operating expense because interest expense is a non-operating expense. So credit non-operating expense. Then lastly, after we amortize the fair value changes of the net assets of the subsidiary, let's now proceed to the goodwill. Again, goodwill is not subject to annual amortization. Instead, goodwill is subject to impairment testing. So, goodwill will only be reduced if there is an objective evidence of impairment. So, the problem states that the goodwill is impaired by 10 pesos. So, how do we record goodwill impairment? So, to record goodwill impairment is to debit impairment loss. However, we have no impairment loss in our trial balance, and for simplicity, we will just use the non-operating expense. So debit non-operating expense for 10 pesos and credit goodwill so that it will be reduced by 10 pesos. So after we prepare the amortization of excess over book value for 2020, what is the effect of all the amortization on the subsidiary's net income? So the effect is for the inventory, it will increase the subsidiary's net income because we reduce the cost of sale. For equipment and building, this will also increase the net income of the subsidiary as what recorded in the books because we reduce the depreciation expense for the equipment and building. Of course, if we reduced an expense account, the effect is it will increase the net income. Then for the patent, the effect on the subsidiary's net income is decreased because we increased the amortization expense. Then for the bonds payable, the amortization of the premium on bonds payable will increase the net income of the subsidiary because we decreased the interest expense. And for the impairment loss, obviously it will decrease the net income of the subsidiary. So the net effect of all the amortization is a net increase of 45 pesos. So the net income that is recorded in the books of the subsidiary will be increased by 45 pesos when it is presented in the consolidated financial statements. Now, the last eliminating entry is the recognition of the non-controlling interest share in the subsidiary's net income for consolidation purposes. So for the share of the non-controlling interest in the subsidiary's net income, so the net income of the subsidiary must be adjusted for consolidation purposes. So here, based on the trial balance, let's compute the net income of the subsidiary. In its books, it has a sale of 2,490 and a cost of sale of 960, and operating expense of 480 and a non-operating expense of 10 pesos. So that is why the net income recorded in the separate books of the subsidiary is 1,040 pesos. So this is not the net income that should appear in the consolidated financial statement related to the subsidiary, because these are recorded based on the historical cost of the assets and liabilities of the subsidiary. So for consolidation purposes, we need to adjust these amounts based on the amortization that we did in our eliminating entry. So let's start with the inventory. So the effect of this amortization will be a decrease in cost of sale for 4 pesos. So that is where we get the 4 peso credit in the cost of sales account. Then for the operating expenses, we debit a 3 peso here that is related to the patent that we amortized, and the 44 pesos we credited in the operating expense pertains to the two credits related to equipment and building of 2 and 42 pesos. Now, for the non-operating expense, the debit pertains to the goodwill impairment, and the 10 peso credit to non-operating expense is the credit that we did for the amortization of premium on bonds payable. So after these adjustments, so the sales of the subsidiary that will appear in the consolidated financial statement is 2,490 because this is not affected by the eliminating entries. Then the cost of sales that will appear in the consolidated financial statement is 956 pesos, which is lower by 4 pesos compared to what is recorded in the books of the subsidiary, which is 960 pesos. Hence, the gross profit was increased to 1,534 because we reduced the cost of sales. Now, the operating expenses is 439 after we added the 3 pesos and deduct the 44 pesos. Then for the non-operating expense, since both debit and credit is at 10 pesos, so the non-operating expense is still at 10 pesos. So the net income of the subsidiary is 1,085 pesos. So that is the 1,040 pesos. Add 58, which is the total credits in our eliminating entries, and deduct the 13 pesos. That is why 1,085 pesos. And this is the net income of the subsidiary for consolidation purposes as adjusted. And the share of the non-controlling interest is 20%. So that is 217 pesos. So if you are asked how much is the subsidiary's cost of sale for consolidation purposes, the answer would be 956 pesos. But this is not the consolidated cost of sale. This only pertains to the subsidiary's cost of sale for consolidation purposes. Because when we say consolidated cost of sale, it must include both cost of sales of the parent and the subsidiary. And the subsidiary's operating expense, that is for consolidation purposes, is 439, and the subsidiary's non-operating expense for consolidation purposes is 10 pesos. So our eliminating entry related to the recognition of the non-controlling interest share in the subsidiary's net income would be a credit to non-controlling interest for 217 pesos. Again, as I have said earlier, Non-controlling interest is the subsidiary's shareholders' equity multiplied by the percentage of their ownership, which means that any movements in the subsidiary's shareholders' equity accounts will also be the movement in the non-controlling interest. And since the subsidiary has a net income, the non-controlling interest must also increase for the net income, only up to the extent of its share. Then of course, that is 20%, which is 217 pesos. And the debit will be share of NCI in subsidiaries net income. So the share of NCI in subsidiaries net income account is presented in the consolidated income statement as a deduction from the consolidated net income in order for us to determine the share of the controlling interest. Because when we say consolidated income, it pertains to the parent's income and subsidiaries' income, both adjusted for consolidation purposes. Then, from the consolidated net income, we will deduct the share of the non-controlling interest in order to get the share of the controlling interest. Now, we're done with the eliminating entries. So, to summarize, these are the eliminating entries. Again, all eliminating entries are prepared December 31, 2020. And our eliminating entry started again with the acquisition date eliminating entry. Then after the acquisition date eliminating entry repeated on December 31, 2020, there are additional eliminating entries that we did which pertains to the elimination of intercompany transactions. Here, the intercompany transaction only includes the dividend income and dividend payments of the subsidiary, the amortization of excess over book value, and the share of the NCI in subsidiaries net income. So after all the eliminating entries, we can now prepare the consolidated working paper to facilitate the preparation of the consolidated financial statements. So to prepare the working paper, we will convert the trial balance into financial statements. So first, I've started with the income statement because technically, among all the financial statements, income statement should be prepared first. So let's prepare the income statement. So this is derived from the trial balance of the acquirer, and this is from the acquiree's trial balance. So this is composed of sales, cost of sales, gross profit, operating expenses, non-operating expenses, and dividend income. Then this is the net income per books. Then I've added another account, which is the share of NCI in the subsidiary's net income. Just like what I have said earlier, the purpose of this account is to determine the share of the controlling interest in subsidiary's net income because this will be deducted from the consolidated net income. Then I've attached the changes in retained earnings for the sake of the working paper. So after we determine the net income, let's deduct the dividends paid and the retained earnings beginning. And this is the retained earnings ending for the year December 31, 2020. Then for this portion is the assets account. Then there is an additional row for goodwill because in the consolidated financial statements, goodwill will be presented. Again, take note that the goodwill is not recorded in the acquirer nor the acquiree's books. The goodwill is only recorded when it is an asset acquisition. However, this is a stock acquisition type of business combination. For the liabilities and shareholders' equity, these are the amounts from the trial balances, except for retained earnings. The retained earnings here is ending. So the ending retained earnings is for acquirer is 6,750, and that is the amount presented in the statement of financial position as well as the ending balance of the retained earnings for the acquiree, which is 5,240 pesos. And I've added another row for the non-controlling interest because part of the consolidated financial statement is the non-controlling interest in the equity section. Now, for the working paper, I've added two columns for the eliminating entries. I've separated the eliminating entries for the acquisition date and subsequent to acquisition date. Then the last column will be the consolidated balances. So let's start with the acquisition date eliminating entries. So let's start with the acquisition date eliminating entries. So these are the eliminating entries that we did at acquisition date, and we repeated these eliminating entries for December 31, 2020 consolidated financial statement preparation. So if you can see that the acquisition date eliminating entries only affects the balance sheet accounts. So there is no effect on the nominal accounts for the acquisition date eliminating entries. So let's check whether the eliminating entry is balanced. So both debits and credits are balanced. Now let's proceed to the subsequent to acquisition date. So this is the amounts posted for the eliminating entries subsequent to acquisition date. For these eliminating entries, it will both affect the real and nominal accounts. So let's check whether the debits and credits are balanced. So for debit is 688 and for the credit is 688 as well. I suggest that you do not just watch this video. Instead, you have your working paper as well, and you personally posted the eliminating entries into the working paper, because it is really hard for me to post this one by one. That is why I just used a formula in order to easily post the eliminating entries in our working paper. So after we posted the acquisition date eliminating entries and the subsequent to acquisition date eliminating entries, we can now prepare the consolidated balances. Let's start with the income statement. So for the income statement, so the consolidated sales is 5,490 pesos. So when we say consolidated sales, this is the sales of the tick company and stock company. So that is 5,490. Always remember that when the question is about consolidated nominal account, it is the summation of the nominal account of tick company and stock company adjusted based on the eliminating entries, without separating the share of the non-controlling interest from the controlling interest. So the consolidated cost of sales is the summation of 1, 2, and 960. Which are the cost of sales recorded in each separate books, which is adjusted based on our eliminating entry. That is why the consolidated cost of sales is 2,156. Then the consolidated gross profit is 3,334. Then the same explanation applies for all the remaining nominal accounts. So the consolidated net income, which is the net income of the subsidiary and the parent, of course, with adjustments based on the eliminating entries, is 2,265 pesos. And this is the consolidated net income. So from the consolidated net income, we will deduct the share of the non-controlling interest to get the share of the controlling interest. So the share of the controlling interest is 2,048 pesos. And since my working paper includes a single statement for the income statement and changes in retained earnings, I deduct the dividends paid. Again, the dividends paid that should appear in the consolidated financial statement is the dividends paid by the controlling interest, which is 500 pesos. And this is the dividends paid by the parent. Remember that the dividends paid by the acquiree will never appear in the consolidated financial statements. Then the beginning balance of the retained earnings shall be the retained earnings of the parent, because this is the acquisition date retained earnings. So the ending retained earnings in the consolidated financial statement is 7,298, and that will be the retained earnings that will appear in the consolidated balance sheet. So 7,298. So that is the amount. Now let's proceed to statement of financial position. So these are the consolidated balances. So for cash, this is the summation of the acquirer and acquiree's cash balance. And for other asset accounts, of course, we need to reflect the eliminating entry adjustment. So again, in the in the consolidated statement of financial position, the investment in subsidiary account must be 0. And here we present the goodwill from the business combination, which is already subjected to the impairment loss. So from the acquisition date balance of goodwill of 1,103, we reduced it by 10 pesos, thereby the goodwill is 1,093 pesos. Then now let's proceed to the liabilities and shareholders equity. So for the liabilities in shareholders equity, same procedure, summation of the acquirer and acquirees liability account balances. And for the shareholders equity, always take note that the share capital account is only the share capital of the parent. That is why the share capital here of 2,000 in the consolidated balance is the share capital of the parent company, as well as for the share premium. Then for the retained earnings, this is the amount we have computed based on this section of the working paper. Then for the non-controlling interest, this is the 1,577 ending balance as of 2020. Now let's prepare the consolidated statement of changes in shareholders equity. So we have four equity accounts. So the share capital, share premium, retained earnings, and non-controlling interest. So this is the consolidated shareholders equity. So let's start with the January 1, 2020 balances or acquisition date balances. So starting with the share capital, we have a balance of 2,000 pesos and the share premium is 500 pesos. The retained earnings is the parent's retained earnings as of the acquisition date, which is 5,750. And the non-controlling interest as of the acquisition date or January 1, 2020 is the fair value of NCI at 1,440 pesos. That is why our consolidated shareholders equity is 9,690 pesos. So this is the shareholders equity that we have prepared in the acquisition date consolidated financial statement. So after the acquisition date balances, now let's proceed to the transactions affecting the shareholders equity accounts. So for share capital and share premium, there are no transactions during the year, so let's proceed to retained earnings. So first is the consolidated net income. The consolidated net income is 2,265. So that is the consolidated net income that we have computed in our consolidated working paper. So the share of the controlling interest in the consolidated net income is 2,048 pesos and that will be close to the retained earnings. Then for the non-controlling interest, the share is 217 and that will be close to the non-controlling interest. Always remember that the consolidated net income will be part of the consolidated shareholders equity of for 2,265. However, the 2,265 will be close to two separate accounts. 2,048 in retained earnings, this is the amount pertaining to the controlling interest or the parent, and 217 which pertains to the non-controlling interest. Now let's proceed to the dividends paid. Again, the dividends paid that will be part of the retained earnings computation shall only be the dividends paid by the parent. And the dividends paid by the parent is 500 pesos. So that is 500 pesos. However, since the non-controlling interest pertains to the 20% of the subsidiary's shareholders' equity, and the subsidiary's shareholders' equity is reduced for the amount of dividends paid by the subsidiary, the non-controlling interest should also be decreased for the amount of dividends that the non-controlling interest received from the subsidiary. So how much is the dividends paid to the non-controlling interest? So that is the 20% of 400 pesos dividend paid by the subsidiary. So which is 80 pesos. So now there are no more transactions affecting the shareholders' equity for consolidation purposes. So the consolidated balance of the share capital in the consolidated financial statement is 2,000 pesos. For the share premium is 500, then the retained earnings is 7,298, and for the non-controlling interest is 1,577, and the consolidated shareholders equity is 13,786 pesos. So this is the December 31, 2020 balance, 1 year after the acquisition date. So to check whether these amounts are equal to the working paper, so the retained earnings here is 7,298, which is also in the working paper, as well as the 1,577 under non-controlling interest. So this is our consolidated working paper. Here is the income statement, then the statement of financial position, and the statement of changes in shareholders' equity.